Good morning and welcome to today's edition of the Interactive Dialogue with Dorsey and Whitney. So exciting to have everybody log in here right before the holidays, and happy holidays to everybody. It's always fun for me to see some familiar names like Jeff, Greg, Cody, Jennifer, Lisa. Welcome to the program. We've got folks logged in already from California, Colorado, Tennessee, Illinois, New York, Texas, Minnesota, South Dakota, Washington, Idaho, truly all around the country here to listen to today's program. As it turns out, as you'll hear, a very timely topic based on things happening in the news. A little bit of information first about myself, and then I'll have Troy also give a brief description. Our format today, as we've done with other interactive dialogue webinars, is rather than having lawyers cram a lot of content through the internet in an hour, we have a discussion on a topic of interest happening in today's business world. You will see on your screen the slides come up. If you have any friends who are wondering why they're logged in and they can't hear anything, please nudge them and remind them to dial in as well to hear the audio portion of the program. There's a chat pane in the lower left-hand corner of your screen, and I'll be monitoring that for questions. So if you have any questions, just log them in there. If you'd like to keep them private, then please say something about private or confidential. Otherwise, I might say, hey, Kathleen has a question, and here's what it is. But I'm happy to anonymize them as well. So my name again is Mike Droke. I'm a partner in the food, beverages, agribusiness, and cooperatives practice at Dorsey and Whitney. Dorsey is a law firm with 20 offices around the world, including 200 lawyers who are part of our food, beverages, agribusiness, and cooperatives practices. We have offices in places including Washington State, Dallas, Texas, California, New York, two offices in Canada, and also, very importantly, an office in Salt Lake City where my friend Troy Keller is an attorney. So, Troy, do you want to give a brief summary of your background?
Sure, yeah. Thanks a lot, Mike, and also very glad to be here. I've been with Dorsey not that long, maybe 6 months. And before Dorsey, I was in-house at a couple of different Fortune 500 companies, really over the past 15, 16 years, I guess, if I count all the years. And it is in those companies, wore a variety of hats, but for the bulk of that time had primary responsibility for board corporate governance topics in those companies, and dealt with a variety of situations from that in-house perspective. So I think this topic and governance in general has been something that's been near and dear to my heart for a long time. But anyway, glad to be with you, and and shout out to the Idaho folks. That's where I grew up. So very glad to hear we have some people dialing in from there.
Absolutely. So it sounds like you spent several years walking in the trenches of the same perspective of many of our participants. So that's fantastic.
I think we'll see eye to eye. Yeah.
I was excited to see that we have donuts on the program, so I want to make sure to get to that. But first, though, can you tell me a little bit about why you thought this particular topic was timely and interesting?
Well, it's, as we'll touch on a little later, it's just been a lot happening on the policy side of that in the last 6 months. Now, environmental social governance has been a trend that's been, globally, it's been happening for years, and investors have been focused on it for a while. But the last 6 months, a lot has happened in the U.S. on the policy debate. What should the SEC do? What are special interests doing? What does it mean for companies in terms of access to capital? So it's become a very topical, salient topic here in the last 6 months.
I was fascinated. Out here in Seattle, we have this little company you may have heard of called Amazon, and they were actually in the front page of the paper on this topic just yesterday. What was going on there?
Well, you might have to help me out there. I remember a headline.
Yeah, they've got, well, it's interesting because, we have different kinds of constituency groups, it seems like. With Amazon, it was a group of worker employees who had bought shares and were making shareholder proposals. But there are other groups as well, right?
Yes, you've got, and what we're talking about generally today will be kind of from that relationship between shareholders and companies. And so employee shareholder groups frequently make up a significant and important part of that. But you've got the institutional shareholders who are in it for the long run. You've got the hedge fund activist shareholders who tend to be more short-termers or looking for quick changes, and that factors into this. And then you've got what I'll call like the special interest groups, NGOs who have a cause that they're promoting, which and more power to them. People should promote their causes. I think what we've seen in the last couple of years is they've in this field anyway, they've sort of caught on that they can use those same shareholder protections as a platform to voice some special interests, and that is in some ways it's good, in some ways it brings some complications.
So I want to start with kind of the good old days of what board governance used to be about, as you say. What was the landscape like in that area?
Well, and it was a simpler time. And Mike, I think you did a little bit of this on the governance side back in the day. Is that right?
Yeah, it's weird. It's one of my first projects I ever had. I was a summer associate in San Francisco, California, and one of the rotations that they do was to put you working with a client. And so that client had a significant investment was being made by CalPERS. And CalPERS, at least at that time, CalPERS, of course, being the public employee retirement system and one of the largest investors really in the world, at least as it was at that time. This, of course, my kids like to remind me, happened in a different millennium. But I was tasked to research what their government activism or their governance activism was because they were taking a very active role in using their ownership position to really drive business and operational decisions at that time.
Well, you were right in the heart of it then. CalPERS then and now also has been has always been the forefront in terms of being vocal about governance and sort of social topics. They were one of the groups to sign on to a petition to the SEC that went in earlier this year that that represented trillions of dollars of investors petitioning the SEC to look at and explore regulation that would require companies to include disclosures on this front, which is maybe scary to some extent, but frankly, if this is going to become it is a real thing, but if it's going to continue to evolve, at some point, frankly, some standardization would be useful if there's some protections on the liability side that are offered as part of that. So anyway.
Why don't you talk about the starting point? You've got kind of three major areas where historically, and I'll take this as kind of like the last millennium time period, I think, the board governance had been focused on. What were those three?
When I started, this is what we worried about. It was, basically fiduciary duties, which, boiled down to it's a complex topic, but really, in my mind, it boils down to, keeping your board informed about what's going on in your company so that when they make decisions, those are informed decisions. And really every issue that came up on the corporate side, that's kind of the analysis you would run. Are they complying with their fiduciary duties? And then otherwise, and then getting to the second sort of bucket there, that otherwise it kind of amounted to the board's job was to hire the CEO, support the CEO, and otherwise stay out of things. And I'm certainly generalizing, but there was a sense of that. And then if the CEO wasn't doing a good job, well, fire the CEO and bring in another one. And then support that one. And that was kind of the governance model. And then of course there were crises when a board might need to step in. But day to day, that was the model, and it certainly has changed these days.
So it seems like the change, you're kind of talking about stepping up in a crisis, and it seems like the change really happened with the radical changes in the law following the financial crisis at the beginning of this century. Is that a fair statement?
I think that's exactly right. That's when I think that's when shareholders and policymakers decided that more oversight was needed, and so many layers of regulation were put in place to sort of force that.
So we have several bullet points on this list, and can you just kind of briefly, for the participants, summarize these two first statutes, which are massive, obviously, but Sarbanes-Oxley and Dodd-Frank?
Yeah, we should go through them. We should go through those regulations point by point. It would just people block out a few more weeks of time, and it would be fun to go through.
Yeah, it's a great way to spend the holidays for sure.
Right. So SOX, everyone I think obviously heard of Sarbanes-Oxley, came out of the Enron debacle, and many basic changes. It required companies to have multiple committees on their board that focused on particular areas, a number of other things. Dodd-Frank focused largely on the financial institutions, but certainly a lot of initiatives that applied across the board to corporations, to public corporations, and so we've got those are layers upon layers that really changed the dynamic. It required boards to have still in an oversight role, but specific oversight in specific areas. Audit committees. Some people joke that an audit committee chairperson these days has it's almost a full-time job, because they've got to talk not just to the CEO or even the CFO. They're expected to talk to people across the board in the company and keep a watch on things that might lead to trouble. So I
remember distinctly when Sarbanes came into play, and my description of it at the time was it was like having a bat loose in your house, which is obviously a bad thing, and you need to get the bat, and so you decide to use a sledgehammer to do it. And so you get the bat, but there's a lot of collateral that may not have been quite what you thought about when you started the process.
Yeah, I think that's a good analogy. And I think people were really freaked out, at the time. I think it's become normalized, though, those pieces of it. And for a while, people were worried that no one would come to the U.S., the financial markets would dry up. That hasn't been the case. We have seen a significant drop in the number of public companies, and I know that concerns a lot of people. And this is a part of that, no doubt. So, I think some upgrades are in order, but it's probably a bigger topic than we could focus on today.
Now, you mentioned here the rise of proxy advisors. First, what are proxy advisors?
So it's a small cottage industry, but quite influential. These are the main three. Really, they're two larger ones: ISS, Institutional Shareholder Services, and Glass Lewis, and then Egan-Jones is a third that people pay attention to. What they do is they make recommendations to the large institutional shareholders about how they should vote. So in the old days, the institutional shareholders, like the CalPERS and the BlackRocks and Vanguards of the world, they had folks that were very focused on the financial aspects of companies, but didn't really have a team set aside to look at the governance. And so they would rely on these proxy advisors to tell them how to vote the shares in the annual meetings each year. And so the proxy advisors, really became quite influential. Some would say their influence has decreased a little bit as the large institutions have said, "Oh, governance is very important. We need to have our own people that are focused on this." But when you think of a CalPERS that's invested in thousands of companies, they just can't really have a team that's big enough to look at everybody. And so still, the proxy advisors have a lot of influence. And as we'll note later, they've become somewhat controversial, especially in the last 6 months.
So you mentioned then shareholder activism and short-termism. What is short-termism?
So yeah, short-termism is, it's been a governance topic / issue for the last many years, and I think what really brought the spotlight in on it was the hedge fund activists who found a model, a financial model, where they could agitate companies to make, and we're not talking about social change in these cases. These are more like company X, you should be broken up, you should pay out a bigger dividend, you should do this or that, looking for a very short-term pop in the stock price, or unlocking shareholder value, as they would sometimes put it, by breaking up companies or making other significant changes. And so that model put a lot of pressure on companies generally to try to get ahead of that and say, look, I don't want to be a target, so I'm going to pay out a lot of, I'm going to start paying out bigger dividends. I'm going to do share buybacks. I'm going to, spin off companies that are divisions that aren't seen as core, and that way, try to get ahead of that issue. And that's, so that short-termism then is sort of the way people on the other side of it say, look, this is really painful for companies, and so let's fight back against that. Let's go back to a long-term model that benefits the long-term shareholders.
It's interesting. Just literally this morning, I was reading in the New York Times an article in regards to concerns about companies, public companies in particular, being over-leveraged right now, and meaning they have too much debt on their books. And I was thinking of this bullet point in the context of that, where instead of using equity to fund a capital improvement project, for example, a company might decide we're going to take on debt so that we can do the shareholder dividend or do a buyback using debt, and therefore increase the share price in the short term, but obviously taking on debt in the long term. So it's literally topical from this morning's paper, as it turns out. And then question, which of these issues apply to non-public companies, like private companies or cooperatives that might be in the food and agribusiness space?
Yeah, that's a great question. And technically, like from a technical perspective, none of them would apply directly to a private company, call it today. But the impact, the trends that happen at the public company level definitely come through. So when you have institutional investors focusing on environmental, social, governance topics, then that sets the expectations amongst those, in some cases, the same investors that are also providing the capital to the private companies. So you think about private equity funds; they now are just as focused on ESG topics as some of the larger institutional investors that invest in the companies. So anyway, long answer, but short answer is no, because these are regulations that relate to public companies. But the longer answer is there's definitely an impact.
Once things, as you said about Sarbanes, for example, become normalized, then they're just normalized. And so for a private company, they may want to have an audit committee as well, for example.
Yeah. Yes, great point. I remember, like, when I started practice, a lot of the private companies, maybe they'd bring on one independent board member just, because it was somebody's friend who they thought they had some technical expertise. Now most private companies from the very beginning, venture-backed startups, they'll have 2 or 3 independent directors, because that is, like you said, it's become normalized, seen as just the smart thing to do to have good governance in your company.
Fascinating. So the next kind of topic we had here was differing views on the board's role in social issues, and I was particularly fascinated by the Wall Street Journal, partly because, of course, I'm the parent of 2 millennials, and that 47% said they believe that CEOs ought to take positions on issues that are important to society, and those folks might not be shareholders, but they're definitely consumers, and can exert pressure in a variety of different ways. So can you talk about the trends that you've seen in the area of the views on the board's role in regards to social issues?
Yeah, I think that these quotes here kind of illustrate the debate, but yeah, that Wall Street Journal quote is, I think very illuminating that people generally, and in particular, I think millennials, I expect companies to lead out in on social things, and you could make a comment there that that it's because people have lost faith in some of the political institutions, sort of above my pay grade, but maybe, I don't know, but nonetheless, the idea that corporations have a social responsibility is, I think, fairly commonly held now. Whereas in years past, I think in particular you would see investors who would really push back hard on that idea, because they'd say, look, people should stay in their lanes. Corporations, your job is to provide a financial return to me. I'm happy to use my money for a charity or whatever to accomplish social good, but that's not your job, corporate management, and don't waste my investment doing that. My sense is that is not the case anymore, and that I think it's a common perception that corporations, especially the larger ones, have some responsibility there.
I've seen this definitely in the area, for example, of the Me Too movement, where you're seeing pressures on corporations that are really different than they were before, and positions being taken by those companies that are perhaps different than they might have been only a couple of years ago. So you see social media having, I think, a really significant impact in this area. To what extent is the view affect agriculture companies, in their agronomy, fuels, or other similar kinds of lines of their business? Do you know?
Yeah, I think so. Like I said, it's a general trend that impacts corporations generally. Each sector has been touched by it in their own way. You mentioned the Amazon point, the news yesterday. Tech companies, for example, there's been a lot of I'd say privacy and Me Too stuff have been things that have seemed to end up on their laps a little more. But for ag and food companies, it tends to be topics like water and carbon footprint, antibiotics in food, GMO, pesticides, herbicides. Those tend to be themes you see surface obviously quite a bit more frequently with those in that sector than in others. Although some of this, like climate change, is almost across the board. It's hard to find a sector that doesn't feel like they need to be responsive to that.
Now, I noticed that some of the types of topics that you've seen are in red. Why is that?
I tried to pick out a few that were and these are all hot topics, but that were sort of hotter than the other hot topics, if that makes sense.
Yep.
So these are the ones that I think you see. You certainly see if you have an institutional investor and they're sort of pointing out the things that they want their companies to focus on. These tend to be the ones you see that come up over and over. And a lot of shareholder proposals also focus on these exact topics. So that's why they're in red, just to kind of highlight these are the ones that we tend to be talking about the most recently.
Now, just because I didn't understand myself, what is a circular economy?
Yeah, that's one that you see that in again in a lot of sectors, but it has to do with trying to not use up fewer new resources. And there's a lot of people who are very skeptical about the concept, but it's a very popular concept in Europe. For example, there have been EU-wide legislation that some that's been proposed and some that's been enacted that requires companies to provide information on where their materials come from and the materials that are in their products, whether it's chemicals or or other ingredients and substances, so that people down the chain can track whether this material fits in a landfill or not, whether it can be recycled. So it's a broader term than recycling, which is one that we use a lot here. But the idea is that you keep materials and resources flowing round and round, and you don't have to use up as many new resources.
It's really helpful to have a list like this, because I imagine for each company that's listening in today, they can understand which of these are likely to be issues for their particular company, and then devote time and resources accordingly, right?
Yeah, and exactly. And that's I think one of our recommendations is that you've got to map out the ones that are most applicable to your company. Unfortunately, you can't there's no list you can go to somewhere that says, even amongst the specific, the groups that purport to rank and rate, ESG performance amongst companies, there's no real place you can go to and say, here's the list that's applicable to our sector or to my company, rather. It's an evolving landscape, and I think there is many different templates and approaches as there are people that that rank companies on this.
So in 2002, a friend of mine was a partner at one of the big four accounting firms, and when Sarbanes-Oxley happened, I asked him what did he think the implications would be for the firm, and his answer was, well, it looks like our workload just doubled. Because now we can't do internal referrals, so we're going to have to get referrals from the other big four, and therefore cottage industries kind of arose in a kind of classic example of unintended consequences. And it looks like that's happening in the area of environmental and social governance as well.
It is. There's so many folks that are sort of putting their hands up rather, and saying, hey, we can provide some analytics here. Unfortunately, unlike the financial aspects of SOX, where the requirements were not clear, but there were standards that were pointed to. There were COSO standards, internal controls, for example, and things that people could look to. Here, there are a few things. There are a gazillion things out there to look at. So it's hard to know, if you're going to put disclosure that in an SEC document, for example, that you have liability for, and in a registration statement for, you have strict liability for. It's just tough, because there's like I said, there's not a clear standard, because you have so many people who have their own view on what it could do.
Now, I think you've mentioned two of these, right? ISS and Glass Lewis as proxy advisors. Is that right?
Yeah, that's exactly right.
And then who are the other kind of players that you've identified here? Obviously not an exclusive list or exhaustive, but...
Yeah, no, not at all. So a couple of these, so Sustainalytics, OWL Analytics, I think those are the two. Those are the two that are pretty much, not exclusively, but pretty much just focus on providing these kind of rankings and ratings and analysis, rather, on what a company's ESG performance is. Some of the others, like Thomson Reuters, we all know who Reuters are. This is it's a place you can go and get financial information on companies. They've added this as part of their offering. Aberdeen Standard, that's a money manager, so they take ESG into account in what they're doing in their investments. State Street is an asset, similar to an asset manager, but who again put out a lot of put heavy emphasis on ESG and what they do. MCSI is it's like an investment research firm. They provide they create and sort of provide stock indexes, and again they have and so what they've done is create indexes that are ESG focused, and so it's again, cottage industry, you have people coming from different places, but all very focused on this topic.
One of the interesting things that's happening in the agribusiness world is that the advent now of private equity money coming in and literally buying up everything from growing land to processors and the like, kind of all the way up the chain. And so I was interested to see you identify the impact investing as one of the new implications of environmental and social governance. Can you talk to that?
Yeah. And so earlier in the discussion, we talked about how is this relevant for the private companies, and here's a great example of how it's become very relevant. Like I said, it sort of started with the institutions investing in public companies, and a slowly growing trend over the last 10 years or so. And so you've got like in the Black Rocks for several years they've had funds that tout and focus on ESG performance of companies in those funds. Now you've got private equity firms that have the double impact, suggesting dual impact, both a financial return and a social return. And so Bain Capital has made, just in the last year, they've made several investments. I think, I was looking at the other day, they've been investing in recycling, in vegan fast food restaurants, home care facilities. So they're making investments that have kind of a social purpose.
Fascinating. And so for the companies that are in that, market of food, beverage and agribusiness, does that mean that the concept of ESG management is now a need to have rather than just a nice to have?
It's a fast moving trend, so I hesitate to say that it's a need to have. But I think you'll get every opinion. You ask 10 people, you get 10 opinions. But I would say it's more than a nice to have right now. I think it's maybe somewhere in the middle. Depends on the type of capital you're trying to raise, what your long-term plans are. But definitely, it's obvious there you have more access to capital if you're able to, show and promote the social benefit of what your company does. I think that just opens up more potential capital. So again, it kind of depends on where you're headed. If you're trying to grow, if you want to be a public company at some point. All those factor in that might push you more to the need to have side of it.
You mentioned a fast growing trend, and I was just really honestly a bit blown away by the speed with which certain major developments are happening. Can you kind of walk through what's happened in just this last 6-month time period?
Yeah. So as you can see from this list, a lot, and it's like I mentioned before, it's the trend has been there for a long time. What's happening now, at least in the U.S., is the policy level debate has really heated up. So just to rattle through these, it might just, jump in if it's if it's going too long. But just to rattle through them, this summer Delaware enacted a sustainability certification law. It took me by surprise that provided a way for companies to say yes, we certify our sustainability through this framework Delaware was offering. To my knowledge, no one has, at least certainly no major company has signed up to it yet. So we'll see where that goes. But clearly Delaware felt there was an opportunity there for or a desire there, a demand out there for companies.
And can I just ask a quick question on that? It sounds like that is a permissive statute, not a requirement, right?
Oh yes, sorry, that's exactly right. It's 100%. It was meant to, this issue with the fact that there are no clear standards out there. This was meant to kind of, let companies sign up and say, here are our standards, and in a formal sort of certified way. Just
even from a definitional perspective, the idea of what is sustainability, what does that term even mean, right? And now we have some clarity, at least for Delaware, which obviously is a super important jurisdiction for corporate America.
Yeah, and Delaware a couple of years ago, I think innovated with the with allowing companies to incorporate as a sort of as a social to have a social purpose if they wanted to. So like Etsy, I think, was the company that the first one to do that, but then abandoned it not too long afterwards. So it's Delaware's been trying to provide really a framework for companies that want to show that they're sustainable. And like you said, sustainability, it's a catch-all phrase, and it means a lot of different things. And that was sort of the goal here, was to help companies be clear as to what they meant.
And then it looks like a series of things have been introduced in various jurisdictions, not obviously the law yet, but at least demonstrating the positions that are being taken in government.
Yeah, and so there's the legislation that came out. Elizabeth Warren introduced. I mean, it's not going anywhere, and no one ever. I don't know. I don't think anyone really thought that it would, but nonetheless, it sort of shows that that she saw some value in raising the profile of some of these issues. What I would say are the most significant items in here from a practical standpoint, that October 1, 2018, that a petition for rulemaking that this coalition of NGOs, academics, and investors, that I think, the SEC 2 years ago, sort of under different administration, had hinted that in one of their concept releases mentioned ESG and looked for feedback from investors. It was one of many things in that concept release. The comments they got from that really overwhelmed. So I think this is clearly under this administration, it hasn't gone very, very far. This petition, I think, is a bit of a reminder that investors really do care about this. We'll see where that goes. The other, you marked the other one that I would say is the more significant. That SEC held a proxy roundtable just a few weeks ago, and a lot of that spurred, and leading up to it, there's a lot of public debate around proxy advisors, other things too, but also around proxy advisors, whether they were, helping or hurting, and what, whether they needed to be regulated themselves. And so that, this whole, anyway, there have been a number of topics here that have burst out, and ESG is, either directly or tangentially related to all these.
Did any concrete requirements come out of the roundtable?
No, it was a discussion. The same, like the day before, you'll see that legislation that was introduced in the Senate, and that legislation basically would suggest that, would require that proxy advisors be regulated by the SEC, and so there'd be more transparency into what they're doing, and and they'd be, they'd sort of be audited once in a while. So I think that the reason I think that one has a better chance than some of the other pieces of legislation mentioned here, a similar bill passed the House last year, and so this one I think has bipartisan support. It's probably not high; it's not the highest. We've got to get a budget passed first, right? So I don't know when it'll be it'll be taken up seriously, but it wouldn't surprise me if some version of that gets passed here in the next 12 months.
Oh. Excited about donuts, not so sure about titanium dioxide. So you referenced some shareholder proposals and also some interesting ironies. So what are the proposals, and what are those ironies?
Yeah. So that picture really makes me hungry. I think I'm if we finish this off well, we can reward ourselves with a donut, Mike.
Nice.
Yeah, it's the proposal was from an NGO. In these case studies are we're sort of focused on food and ag related companies, and that's one thing they are. The other thing they are is they also show, here's kind of the dark side to ESG, if you will, that it provides this platform when when investors are focused on it. It provides a platform potentially for NGOs, special interest groups, to also make use of the attention that it's getting to promote maybe a special interest they have, and so that's what these I think show, and also there's also liability concern here, and we'll touch on that. But so Dunkin' Donuts, they got a shareholder proposal from an NGO. It's the same NGO that has had shareholder that has used that platform for a number of other companies in this sector. I can rattle off a few, but Hershey's, Krispy Kreme, Starbucks, General Mills have all sort of been on the receiving end of shareholder proposals by this NGO. And in this one, they're focused on nano particles, and so the proposal to Dunkin' Donuts was to not include in their food items titanium dioxide as an ingredient because titanium dioxide came with some nanoparticles. And this is one. I mean, I just find it a fascinating story because the titanium dioxide is an inert chemical that is used in so many things. I mean, it's in the paint in your wall. It makes the paper that you're touching right now, kind of look a little brighter. It's we sort of walk and touch and live and breathe it, every day. If you think about it as it replaced the lead in paint, several generations ago. So it's one of those actual innovations that have made life healthier. And so but nonetheless, it was the target here, and Dunkin' Donuts, they just quickly deselected that it didn't want didn't want to deal with it as a sort of public relations issue. The irony, I suppose, is I think people close to it, might be surprised that that's the thing they were getting. They were getting the PR issues over when, no one's going to say donuts are a health food, right? Maybe part of a good
what? You're rocking my world here. I thought now it was a sustainable health food since we didn't have nanoparticles, whatever those are.
Well,
yeah, I thought this was fascinating in part because it shows the and I'll use this word in a literal sense, the granularity of the focus by the shareholder, in this case the NGO, on the way that the product was being prepared. I mean, literally into the ingredient level.
Yeah.
So
hyper-focused. Yeah, exactly.
And I remain undeterred in my position that donuts are a sustainable health food.
Part of the balanced diet, no doubt.
Absolutely. So the next kind of case study you had involved glyphosate, right?
Glyphosate, yeah.
Glyphosate, and which we often call Roundup, among other products. And so can you talk through kind of what happened in this shareholder situation?
Yeah, I mean, so glyphosate is, that ingredient, which is the active ingredient in Roundup and a lot of, herbicides, has been a controversial product for a long time. I mean, sort of around the world, people have, they see how effective it is and how much it's used, and so there's concern that it could have a downside. And so this is not. I'll just say this is not a secret to anyone that this is a controversial product, right? And certainly not a secret to Monsanto nor to Bayer, who acquired Monsanto earlier in the year. And so these shareholder proposals basically encouraged Monsanto to prepare reports on the potential financial impact of the public policy developments. I think, I don't know, you can see Monsanto saying, well, look, haven't you read everything we've been saying, that, we're dealing with this stuff all around the world, we've got disclosure, we got risk factors on it, et cetera. But in any event, those proposals were there. 2 months after Bayer acquired Monsanto, there was a pretty well-known jury verdict that gave a plaintiff almost a $300 million award. The plaintiff alleging it was a glyphosate-induced cancer. And
that was a single plaintiff case, right? So not a class action?
Single plaintiff case, yeah, exactly. And on the heels of that, now there are thousands and thousands of cases have been brought. So that liability prospect, clearly, has hurt Bayer's stock price. This chart here shows a significant stock drop. Now, of course, the whole market's gone down quite a bit in that time frame as well. So it's hard to know how much of that is market, how much of that is this liability prospect. But clearly, no doubt, a lot of it is the liability prospect.
And so you kind of posed the essential question in the final bullet point for this topic, at least, which is were the proposals, the shareholder proposals, prescient, or did they simply contribute to the perception of harm? So what do you mean by that?
I'm somewhat responding to, if you look at the source of the chart, Shareholder Rights Group, they sent a letter to the SEC in which they said, SEC, you need to make the rules, not restrict the rules for shareholder proposals. In fact, maybe make them even easier, because look how smart these proponents were. They saw this issue before the rest of the market did, and I don't think, for one, the issue they were pointing out was not litigation exposure in the U.S. It was sort of public policy type thing. So, but in any event, it was not an issue that was a secret to anyone. So I don't know. In my mind, it didn't. I think their point is probably exaggerated here, but nonetheless, it shows how shareholder proposals, this governance mechanism, is being used by by special interest groups, and it is and it can be a real challenge for companies.
So in other words, the people who were making the 2016 and 17 shareholder proposals used the stock drop as a kind of proof that they were right in having made those proposals, and asked the SEC to loosen the standards for requiring a vote on proposals. Is that essentially it?
Yeah, I don't know if it was, actually I'm not sure if it was them or just this other group that used them as a case study, but that's exactly right. And it goes to the larger story here, which is how are we going to, from a governance standpoint, what are we going to require companies to provide disclosures, and in what way, and how's that all going to shake out? And so it's a part of the debate, and I think it's a great example of where the debate is at right now.
I thought this topic was particularly fascinating for the audience here because it's so directly pertinent to food, beverages, and agribusiness generally. Obviously, many use Roundup as part of the farming process and the like. We've had both statutes, regulations, and activism in regards to GMO and other similar topics. So what do you see this as part of a bigger trend for agribusiness generally?
Yeah, I do. I think shareholder proposals in the last year or two, the number of them that have focused on sustainability topics, it's now become the largest category of shareholder proposals, which is really shocking. You go back just a few years, and shareholder proposals tended to be there were always sort of one-offs on some sort of interesting topic, but most of them were on traditional corporate governance topics like should companies have takeover protections, should the chairman and the CEO should those roles be divided. Those were the kind of things that most of them were about. But these days, the largest category again is on sustainability topics. And so if you're a food and agriculture company, a lot of those sustainability topics, I mean, you're right at the crux of them. When you think about how food is made, a lot of questions and some of the things that you mentioned, Mike, and then water usage, also a big topic, and in chemicals, how those are applied in the food chain. also a big topic. So a lot of these land right on this industry and the industries that are right around it.
So I just loved your next graphic. It was like, pow, SpongeBob fell over and split in half or something. So climate change fraud versus political opportunism. When you have states like New York involved, obviously New York is an extraordinary market, extraordinary jurisdiction and state. Can you talk about what New York and their Attorney General's office is doing in this area?
Yeah, New York and Massachusetts, and for a while the SEC had been looking at this issue. New York's been doing it for several years now. Have been investigating ExxonMobil on this point, suggesting that Exxon's climate change disclosures were not done appropriately, and then I think to cap it off here, just a couple of months ago, the New York Attorney General's office started an actual legal action against ExxonMobil, purporting to be the litigation on behalf of investors in Exxon. So it's a securities law based action, which I think is sort of fascinating if you think about it, and arguing that Exxon has misled its investors. This one is there's a nuance here that is I find very interesting. Normally in a securities fraud case, you've got the plaintiff saying that the company has been knows the real truth, usually like a negative thing, but hasn't disclosed that to its investors or lied about that negative thing to its investors. Here what happened is that ExxonMobil had taken upon itself to go out to investors and say, look, we're in our financials we're applying a proxy cost. We're trying to estimate what the costs of climate change policies and regulations around the world, what those costs will be to our operations. So we're applying this proxy cost, and here's what it is. And what New York is alleging is that internally Exxon didn't really apply that. So they said they were, but they weren't. So what's funny is, and there's a Wall Street Journal op-ed on this a couple months ago, but it's almost as if New York is saying, Exxon, it's not like you had a negative thing you were hiding. It's that you were saying what we think was true. You just didn't believe it yourself internally. It's like you were lying not to investors, but you're lying to yourself.
To yourself, yeah.
Yeah, it's a funny one.
I find this fascinating. It's definitely a trend that we're seeing here on the West Coast, that you hear on news media and papers and the like a lot about gridlock or lack of action on the federal level. But really where the action's happening is on the state level. I mean, just jumping back to your slide on the topics, you've talked about Delaware with the sustainability law, now New York Attorney General taking legal action in regards to climate change. I could tell you that, California has really set the standard for labor practices, workplace diversity statutes, and the like. And so you see these kind of state actors really asserting a much more primary role in effecting regulatory change, even over things like the SEC or Congress, right?
Yeah, absolutely. There's a lot happening at the state level, and that's why I said this New York case is also interesting in that it's a securities law case. The SEC investigated, decided not to do anything. It's just normally you would think this would come from the SEC. It's coming from New York. It's fascinating.
And are those kinds of cases filed in the state level, or are they in federal court? Where do they land? Do you know?
Yes, state level. It's the securities laws they're using is a New York law called the Martin Act, which is kind of a broad anti-fraud type statute. So it has been used in other contexts. But this is so it's definitely sort of state level at every point, the law and the forum.
Fascinating. As the proverb goes, right? May you live in interesting times.
Well, we certainly are, yeah.
So, next, and I guess our final topic goes straight to job security for us and all the folks that are listening in. Really, what are the things that a professional can do to help their company be better prepared in this area of such rapid change?
I think there are a few must-dos, and then a few that I think interesting things to consider. So, like the must-do, and I think people have heard this plenty of times before. You've got to stay close to your investors, and especially your larger institutional investors. Know what they're focused on, know what they're looking for. In the end, if your investors are on your side, then if you get a shareholder proposal, it's still a PR issue, but it's not really a governance management issue because you've been in dialogue with your investors. You're focused on the things that you at least provide disclosure on the things they want to hear about. So I think that's sort of rule number one. And a couple other bread and butter things you can do. You can, the people that do the analysis and the ratings on ESG in particular. We mentioned earlier how there are a bunch of them. I think a lot of people on this call will have received questionnaires from a variety of those that say, hey, tell us what you're doing, Company X, in this area. Some of those can be very time consuming. I know on top of people's day jobs, it's painful to have to deal with those. I think that there's some value though in filling those out because you're able to present the good things that you're doing and address maybe head on some of the things you might be criticized for, and that's a way to do that. Similarly, I know it's tough for a lot of people to want to do it, but if you buckle down and sort of hold your nose a little bit maybe and pay the fees that proxy advisors will ask you to pay, so you can get their input into how how some of your disclosures are in their view. I think that's again, if you have the budget for it, that's worth it's probably worth doing. An idea or two here that I think would make a lot of sense, especially again given how fast this trend is moving. I would suggest companies should put together a working group internally. Certainly that has the legal folks in it, and obviously the investor relations folks as well. But that would also include if you've got like a government relations team, that you include them in that working group. Your public relations folks, your marketing folks. If you have a sustainability group, put together a working committee, because you want to be able to. You're trying to do a few things there. The legal folks, they're preparing the SEC filings and dealing with some of the governance issues with the board. So, they're the ones that I think, at least on the legal side, are on the front line, of course. But when you're trying to get ahead of these issues, and so that when you do get a shareholder proposal, the board says, this one's getting a lot of shareholder attention. How did we not see this coming? Well, so you can avoid that moment, right? You can, so you get together with your IR folks who know what current investors are worried about. You get together with your GR folks who knows where who can tell you where the public policy is headed, and you talk to your PR and marketing folks who see what other people in the ecosystem, what your customers, what the NGOs are focused on. I think you get that in that way, with that kind of a dialogue, you can make intelligent decisions about the types of areas that you should be focused on.
It's interesting. What you're really saying is you're replicating the external constituencies with an internal group that's already really looking at those external constituencies, but looking at it in a more focused way, right?
Wow, that's a great way to put it. Yeah, the groups externally are doing the same thing. So here's a way to try to match up with them and understand where they're coming from.
The other thought I had as you were describing that is it gives you a great platform to be able to very quickly analyze the interdependencies in a moment of crisis. You have a complaint that's filed, an allegation that occurs, and you need to understand, okay, so what is this? How do we handle it culturally, legally, and then also from all the ways that various constituents are likely to react. So it sounds like a really good recommendation just generally. So with that, we're at the end of our time, and a couple of things for participants. If you're interested in getting continuing legal education units, you'll be receiving, and actually also on the sign-in sheet was attached to yesterday's reminder email, information about the program. You email that to Michelle Hubble, who manages our continuing legal education group, and she'll get all that set up for you in the jurisdictions that you're licensed in. And of course, if you have any questions on this or other topics in regards to your corporate governance issues generally, or corporate law matters, I encourage you to contact Troy, whose contact information is here, or you can contact me and I'll get you in touch with the right Dorsey professional for the topic of your interest. So Troy, thank you so much. Fantastic program, super interesting. Thank you so much for reconfirming that donuts are part of the essential food groups, and I do encourage everyone to ask Troy questions as they come up in this area.
Hey, thanks, Mike. Thanks for the opportunity. Thanks, everyone.
All right, and with that, that concludes our program. Thank you.